All right. Good morning, everybody. It's spot gamma levels for today if you want to take a screenshot. All right, so red around the world, Hong Kong is slightly green, 0.5% to the upside. Everything else is flat to negative, with the Russell being down the most, 0.5%. So anything less than 0.5% doesn't hit my benchmark. It's considered flat to neutral until it gets above or below 0.5, 0.5%. We can see the UK also up just 0.25%. It's not up enough, but it shows they very likely are a little bit of the help that we're getting, right? Because they don't close until 10:30. Kind of a busy day. All of these today, US retail sales and retail sales minus autos. The the danger is the Fed speakers. It only takes one to speak out of turn, say something they didn't exactly mean to say, or say it in a way that a reporter misunderstands. It gets reported incorrectly, and we get big volatility in the market. It's happened before, it'll happen again. And it's usually one of the biggest threats to when a Fed speaker is out there chipping teeth. Now, granted, it does matter where they're speaking. So, if you were diligent and you wanted to dig a little deeper, finding out where they're speaking and what the topic is can help you determine whether or not you really need to avoid it. Because if it's a pre-recorded message at Boy Scouts of America, for an example, there won't be any questions. He won't inadvertently say something, and there's no Q&A afterwards. So very unlikely to move the market, right? So not all speaker events are equal. And while generically you can just avoid them all, you could dig a little deeper, and find out more information. So we can see retail sales have the historic precedent of moving markets. So that's why we've got the red boxes here. Takes a look at what's happened in the past and tells you whether or not this economic event has a history of being volatile or not. This is really helpful for new traders who don't know which economic events to be worried about and which ones that they don't really need to be too concerned about. It's no promise or guarantee. It can show something really light, implying that it doesn't have a history of making the market violent, and then we can still see violence. So it's not guaranteed, but it gets you pointed in the right direction. So far, the banks are looking really good, all things considered, but the argument has never been with the big banks, right? They managed pretty well through this whole incident. It's been the smaller banks. So it's a good start, to be sure. They were talking to somebody the other day about those comments made by Jamie Dimon. And I can't remember the name of the person they were talking to, but his answer was, Jamie Dimon's jumping up and down like a little boy crying wolf and talking about how bad it is out there. While at the same time, the amount of money that his bank needs as a part of the stress test requirements, they met that goal like 9 months ago, and they over allocated how much money that they needed in there. Call it like the rainy day fund or the, oh, damn, something's going wrong fund. And now they're reducing that fund's size significantly. So if he was so adamant and concerned, put your money where your mouth is, his money is showing that he's not concerned. So there's a disparity between what he's out saying in the public and what he's doing with the bank funds. And that's not unusual, right? They want to publicly, when all those bank CEOs, everybody, they're just talking their book. If they want you to buy what they're selling, then they're going to tell you how it's such a great time to buy Apple and Google, you know. And if they want to buy it, they need you to sell it, then they're going to be jumping up and down telling you how bad tech is and it's trash and it's not going to come back for years and you should sell it so that they can buy it. Good times, right? $8:15, $8:30, $9:15, $10. It's a busy day. And this doesn't even count all the Fed speakers today. Now, a lot of times I say watch the clock, and that seems to confuse people, like there's something special to it. First, the government's lazy. Everything the government is going to do, it's going to happen on the clock. When, just for an example, the White House wants to dump data, they'll do it on a Friday afternoon around 4 o'clock, right when the market's closing, right? That way they can dump it and, oh, well, you know, we're going home for the weekend. No comment, no questions. News hits dumped by agencies on the hour. The market's open at 9:30. Dollar 8.15. Bond yields, right? Everything's got a time frame. So watch the clock. Even these 8:15 housing starts. So every quarter hour, every half hour, and every hour, you get some volume and the potential to see a change in the market today. If we're at the lows testing against support and it's a new hour, that is where we could flip and just go the other direction. Testing the highs and it's at a new hour, it's where we could flip and go the other direction. Go back in the charts and look at it. On an intraday basis, how often does the market change an entire course and go the other direction? On the hour, on the half hour, but mostly on the hour. So watch the clock. I changed this morning, but I guess I didn't change the date. And so maybe it's the right one, maybe not, but better to just check. There we go. Now I don't have to worry about it. All right, we tried to get through the 10-week yesterday. We weren't able to keep it. Now we've sold back down through it. We're resting right above that volatility trigger. So volatility trigger is kind of a little weird. You can hit like YouTube, Spot Gamma YouTube, and you can look up things like volatility trigger. The main thing when it comes to the volatility trigger is bullish above, bearish below. Now that's not exactly perfectly true, but it's good enough. They will sell into selling and buy into buying. So especially if we get through that 0 gamma level, but definitely when we're underneath the volatility trigger, the distance that a market could move to the downside increases exponentially. They've got this really nice dot plot, and it shows the volatility trigger up and down rather than left to right like I'm showing it. And it showed these dot plots of how far the market moved when it did cross under the volatility trigger. And it was some of the biggest moves that the market has ever made. It first has to start by getting through the volatility trigger. So just because we're underneath it doesn't mean they're automatically selling into selling, but they wouldn't sell into selling if we were above it and going down, right? That's a good way to even start the conversation. They won't sell into selling if we're above that line and going down. So bullish above, bearish below. We're still above it on the ES. It's a really good place to start. But it kind of needs to hold. We get through that, we'll start to focus on 0 gamma. We've got the 10-day moving average underneath this around that 43.74. And the put wall is a long ways off. I don't really think we have to worry about it. It's at the cog line 43.30. So that put wall, not really a big deal for us right now. Same thing with the call wall, 44.80. It's a long ways off. I don't think we really need to worry about those walls. We're still underneath the previous week's high. We don't have a daily MDP, a missed daily pivot, because we've already hit it. We had expanded reasonably well above the weekly pivot point, but we're already coming back to it. And it's interesting to note, however, it's a part of the argument for long or short. We're starting to bring that weekly pivot point up with us. So if we look at last week's weekly pivot, the distance we got from it, how far above it we closed, the math brought it forward, brought it up to 43.60. That's a minor blimp in all of the reasons to think that we're now working our way back up. But so far, we are working our way back up. Now, we do have a little bit of a threat so far this week, but the week isn't closed. If we were using OCR style analysis, then last week we had that higher high and higher low and higher close. That is the change, but we need 2 higher highs and 2 higher lows and a higher close. Now the week's not done. We do have the higher low, but we don't yet have the higher high. So we need that. Otherwise, we're going to have an inside week, and it'll be not the end of the trend, because the trend hasn't even been defined yet until we get that second high, but it'll invalidate the trend that we were working to build here. So we're still focused on last week. 43.65 is the 50% mark. We're holding above it reasonably well. We got both of those 10-period moving averages over our head to deal with. This is the EMA, but the SMA is up there too. Volumes within normal range, nothing wrong with this. No warning here. There's no market maker move, implying that they're not hedging. They're not worried about any of the economic data that's coming out today. Ten-day, 30-minute volume profile. When we're at the lows, we expect to go to the highs. When we're at the highs, we expect to go to the lows. We're right at the point of control. We've got all of the volume up here with this. Got a classic B. If we break this low from Sunday, Friday, that 43.50, it gets very shallow. There's nothing here. We could drop down through it to 4,300 really fast. The thing is, whatever we hit here last week, it wasn't on this chart. And there's got to be some kind of concern that if we come back down into that 4,350 again, whatever we hit last time, we're going to hit again this time. We certainly didn't build any volumes there. Still, shallow area should move through it relatively quick. We can see a more minor version of that here and how quickly we moved through that zone. All right, we're going to take this VPOC off. It was hit, so it is done. I left it on there in case we were going to come back to it, and we didn't come back to it. We do have a VPOC from yesterday. So if we make moves to the upside today, that's very likely going to be a first touch rejection. Got to get to it first. Got a lot of stuff in the way. We're building up some volume today underneath that 4,400. So just getting back to 4,400 is going to be a little bit of a trick. That's where the most volume is at so far today, is at 4,397. So it's going to be difficult to push through there. At its most basic form, if we look at this volume profile at where the point of control is, it's telling us where traders were most willing to make a trade, right? I mean, just, that's where the most volume is. So it's where the most people were willing to make a trade. Leaving aside any bias that goes with that, were they bullish traders, bearish traders? They were, so what? Who cares? That's where all the volume happened. The greatest amount of volume happened. So there stands to reason if we go back up to that point of control, there's still going to be a lot of traders who want to trade at that level. That's a really nice way to look at it. This strips out your own bias. And it also strips out any unwanted additional feelings that you might have about it. So the expectation is when we get back to the point of control, we're going to see a lot of trading there. It might be enough trading to keep the market from getting above it. Can't say for sure. But we can say that's where the most volume traded. All right, we're still within range for the week. We got a little close to the edge yesterday, but close doesn't count. Hand grenades and horseshoes. We're back, not back. We're still below the 10-week, but we've been working our way back to that 10-week, kind of implying what we were just talking about, that we are beginning to move up off of these lows. I've been arguing for, I don't know, 2 months now, that we would have the beginning of October as the lowest and the slowest, that we would, have that negativity kind of fade off. We get a lot of bears involved, really get them convinced that we're headed down, and then flip it on them, and that we would start working our way up to be closer to the high by the end of the year than to last year's low by the end of the year. And so far, that's playing out. So I've been looking for this bullish turn. And I think now that we're starting to see it, right? Still need more information. If we're doing pure price method, then we've got a higher high and we've got a higher low, and that's a good start. Price needs to break this previous high, say from 1012, 44.28. We need to close above that on this time frame for a daily. Then we would have our upside move, right? Or at least we'd have the confirmation that this downward move is done. And yeah, there's a head and shoulders here too, but we was kind of talking about head and shoulders yesterday, and how they're basically the last refuge for someone who doesn't have anything else to say about a market, right? Especially on a daily. Can't tell you how many traders I've seen who said, well, I went long because this inverse head and shoulders and it's not working. Or I went short because of this regular head and shoulders and it's not working. Or I'm staying in it because of this head and shoulders and it's not playing out. It's a daily. It could take a month or more to play out, and they usually don't anyways. So, if that's the only reason that you're trying to go long is this inverse head and shoulders, probably not a good idea. Now, intraday, I've had a lot more success with head and shoulders, especially narrow, clean head and shoulders. But these daily and weekly ones, nah, they're not worth it. So it is there. Neckline break is pretty much the same level, 44.28. So we would just measure the entire thing. 50% would be 45.11, the cog line, and 100% would be 4600. Gee, it puts us right up to the levels that I had already been targeting anyways. So dun, 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 dun. Anyways, we're looking to cross through the 10-week some point this week. That'll begin the transition for the next wave. I know these don't really look much like a wave, but it is a wave in there. So we're looking to come up through the wave bottom, come up through the 10, expand above the 10, and then get our next pullback. But that 10-week will act as resistance, so we got to be careful as we come into it today, if we do continue that upside move today. Here's the 10-day rather than the 10-week. We had already completed the wave. We were above it, came back down, messed around with it. Now we're trying to hold above it. Still think it owes us a wave down. So kind of looking for a little more pullback here. But we've seen examples last year or even earlier this year where we got around that 10 and just kind of tapped it and went right back up again. So we're not overbought. We're not oversold. We haven't moved too far, too fast, and it doesn't owe us a pullback or a move. There's no linear regression or mean reversion implied or owed. We got to get out of this zone. Bullish or bearish, we got to get out of that. Doesn't even matter which. So obviously bullish above, bearish below. And if you want to start with that short, you got to get through 43.84 for a short break below yesterday's 50% mark, and then target it all the way down RTH levels first. So say to Globex high, RTH open, Globex low, Globex open, level by level. And that would get us down to the weekly pivot point too. So far, there's not that much bearishness out there. think I broke my think or swim. Come on. China ADRs, the K-Web constituents, they're down 0.75%. So JD, Baba, Baidu, Neo, XPEV, those kind of things. Only down 0.75%, so they could get a flip. Remember that China was up this morning, right? When we were on the webpage. So we got a little discrepancy, right? A little disparity there between Hong Kong here and those China constituents, China ADRs, the K-Webs. Could be just one or two names dragging that entire ETF down. That's why we also look at the other China ETF. K-Web is more internet, and this China ETF is more kind of like a SPY version for the Hong Kong or China. So bonds are down, the China constituents are down. Nothing else meets our benchmark for 0.5%. Take it the other direction. What's up at least 0.5%? Nothing meets our benchmark. What we don't have in there, which is why I usually come over here, is things like a really good pot stock ETF. Now I could have put MSOS in there. I've been thinking about it. I have to take something out. So we could see that pot stocks are up this morning mildly. I mean, they're not like wow, but 0.5%. It's kind of our benchmark. It's what we got to see, and we have that. Solar is down almost 2%. That's impressive. So consider where it closed yesterday, seeing way up here around that 49, and it's down this morning at 48. It's at the top of this zone, so I'd be a little careful. That does look a bit like a Busby, but look at where it's come from. You know, I mean, it's been a consistent, persistent short for a while, right? Yeah. I mean, that's just sexy. All right, TLT bonds getting a little bit of a smackdown this morning. There's so much going on in the bonds market and the treasuries that don't try to catch that falling knife. Just let it give some good solid turns and stay on the weekly chart, the monthly chart. You know, go to the daily to maybe take some trades, some short opportunities when they come along, or you know, a little bit of mean reversion to the upside. But it's definitely not time to long bonds. Uranium down 0.5%. You know, uranium is not supposed to act like penny stocks and it's or you know, like big tech. So it's been wild and crazy. It's got to digest a lot of this move, and you know, so far it's looking like it's not done yet. My expectation has been a half back at least. So if you kind of consider, you know, where did this run start? We don't have to take it down to this lowest point, but we will just you know, try to be as fair as possible with it. This doesn't count, right? We wouldn't count it way down here because we had all of that consolidation before that crazy move, and it's this crazy move that it's trying to digest. So either from this low, I think that's fair, or from the low before the run. And that also, I think, would be fair. Either one. It's not right or wrong, but we'll use this low. That is the half back level. So, you know, it kind of needs to hold. I like round numbers. Just call it $24. We get below $24 in uranium, then this whole thing could be unwound. Otherwise, unwinding about half of it, digesting, they want you to quit looking at it. They want you to forget all about it, get out of your shares and leave it alone so that they can make another run in it with you not in it. They don't want to share. Amazing, right? They don't want to share. So they're going to digest it here, kick it around, wait for it to not be in the news, and wait for enough shares, watching the float, and then they'll run it again. But if we break and close below 24, then it's very likely going to unwind this whole move back to 22. A lot of ways to play uranium, by the way. You don't have to just mess with URA. There's better vehicles. All right, things that have made the biggest moves today in the NASDAQ 100 is JD. It's got a pre-market gap of 1%. TDD or TTD, the trade desk, more than 0.75%. Warner Brothers, Discovery, Comcast. So a lot of communication names this morning. Things that are gapped up, pre-market gap percent to the upside. Mondelez, Dollar Tree, Micron, AstraZeneca. But you know what you don't see in there? Where's the fangs? They're not up enough. They're not down enough. So they're sitting on the sidelines. We need them to get into the game. The fangs are a part of it. 3 sectors we got to have, right? For a risk on market come from finance, technology, consumer discretionary. That is the fangs between Tesla, Microsoft, Apple, Amazon, Google. It covers, well, we need a finance in there, but you know, if you're using the NY FANG, you got like PayPal or something. The reason I'm showing the NASDAQ 100 is because if I try to use 0.5%, asking the question, how many names in the S&P are up at least 0.5%? 5. Healthcare, consumer non-durables, finance. Okay, so I mean, we got a few finance, but they're earnings. You know, they're not going to carry the market. Take NASDAQ, how many names are up at least 0.5%? 3. And the same thing in the other direction. What if we're down? You know, at NASDAQ, down at least 0.5%. 13. Technology, Crowd, Datadog, Fortnite, some semiconductor names, NVIDIA, ON, Impasse. But these aren't going to do it, right? So S&P down 0.5%. General Dynamics, Lockheed Martin. So the war machine is down again a little bit this morning. It's not it, right? So there's just nothing out there yet. Oh, I had a good example here on US oil. So this is a daily chart. We had that gap up last week. So we've been moving to the downside. We gapped up, measure the entire thing, mark the half back level. This gap here, what a fantastic gap. What did we do? We went back down and closed the gap. Why? Because gaps get closed. Not all the time. I mean, this isn't always going to work, but I thought, what a beautiful example of a gap close. We gapped up, sucked in everybody, Oh, we're going long, baby. Yeah, long all the way back down to get the gap closed. How'd those calls work? There's your long after you puke out the calls and you decide, screw it, that long ain't gonna work. Where did it go to the upside? Half back level. So now we're digesting here. It's not that we got all the answers, right? We just want to look at what we've got and go from there. Didn't know we were going to close this gap at first. Started with 50% of that bar, got below it, broke the previous low, broke the bar. There's your play. Flip it the other direction, measure the 50%, test it against it, broke through it. Where are we going? Other side, level by level, all the way back up. So now we've got this bar in play. And as long as we're holding above 50%, we could continue the move to the upside, but we got to get through that half back level. So we're looking at gold here, daily chart. Consider this one big bar like a big trend day. What do you do with a trend? Snap your fibs, look for the 786 pullback, right? Digestion, people are taking profit, others are taking their place. So we had the pullback. It did maintain the 786. We're trying that push now. Now that we've got this bar here from the 16th, we can't close below that low. If we do, we're going to run this half back, look for a break, try to take it back down again. Been waiting on nat gas to pop for like all year, right? So finally got the pop, selling into it. At the very least, measure this for that half back level. Kind of take it from the start of the move to the top of the move. Now you could just measure from the top, right? From the breakout point. Either one would be fine. A lot of books will say that this is more valid, but I'm thinking about where the move started, right? Right there, where all those flows, like one shot, 1 week of run. So we're either at the half back level, if you do use the breakout spot, or we're nearly at the half back level, if you use the start of the move. I would argue that now that we have this day here and now we're sideways inside that day, that we don't want to break this low. Even if my half back level was down to here, we wouldn't want to break this low. There is a gap to fill. And the fact that we got that low and didn't close the gap is interesting. So we could get one more drop down there, get the gap closed, bounce and rally back up. Another one of these kind of wick days here where we set a low level and came back up again. We could get something like that just to get this gap closed, which would then also make the way that I have it measured, it would make more sense because we could overshoot that gap close, hit the half back, get the bounce, rally back up. Either way, if this nat gas is going to hold, then call it 3.30, kind of a nice round number, line in the sand. It's got to hold that level. We start getting closes below that, nat gas is not going to continue this push as far as I'm concerned without coming all the way back to the breakout point. That's a lot of unwind. Really don't want to see it do that. Been waiting all year just to get this. Still got US dollar Japan holding these highs. That's a pretty big deal. As long as we're holding up here, the threat is still very real. And that big move there was not intervention. So thanks Bloomberg, right, for getting that out there. All right, we got stocks and bonds moving in step. We got the dollar and the 10-year at odds with each other. They're not working as a group, not working as a team. You want to keep your eye on the 10-year. You can use the TNX in about 10 minutes. You can use the TNX and the DXY. Look for them to start working as a group, as a team, both moving to the upside, both moving to the downside together. Otherwise, watch that 10-year for a breakout. If we do break out, that's very likely going to be more weight against the S&P. So more headwinds. Expect S&P to continue that move to the downside, but we're not looking at some big crashing sell-off. It's just very nice, clean, organized levels at this point. It's concerning, and I haven't had a chance yet to look deeper into this move, but that's some serious violence this morning. So I want to learn a little bit about what happened there. I just haven't had a chance to do it, so I don't want to really try to speculate. So that's what I got, guys, and a big old flat nothing until we get some data and this market wakes up a little bit. Keep your eye on tech, because if it wakes up, it's going to take it. It's going to take it whichever direction tech goes, we're going. It's just got to do the thing. With the 10-year pushing up like this, the expectation would be that tech is going to be down, but it's not down. So it's resisting that. And maybe it's because the Dixie is down, the DXY. With the DXY being down, tech would like it, tech would go up, and tech's not going up. So it's resisting that. Probably these two are working against each other. One is pushing tech down, the other one is pushing tech up, or call it headwinds and tailwinds. One's lifting, trying to lift, giving tech that space to move up, but we're not moving up because it's still got headwinds due to the other side. If these two sync, the Dixie and the TNX, we could see some pretty decent moves today. Watch the ADR levels, keep your eye on the clock. Look for flows, right? The market breadth. If you're on Thinkorswim, you can just use the visualize tab, set it to index, choose your index. I like the NASDAQ 100, but really you don't have to choose. You can actually pick more than one, just detach it. They scrunch up really nice into these little boxes. Put the capital next to the issues, set it to the top, get another one. So you can do, all of them if you wanted to. There's the S&P 100. And there's the NASDAQ 100. Put the capital next to the issues. And yeah, you can just stack those things up, as many as you want. Watch the money, right? Follow the money. Watch the issues. When the breadth starts picking up, you got the confirmation and tick with the weighted AD behind you. You got a full-on trend day up or down with all the breadth behind it. It's a go. It's a play. That's what I got, guys. I'll see you tomorrow.